Hi, Gary Mrzinski here for Part C of Chapter 5, and we're talking about gross domestic product. There are two ways that is measured. One is the expenditures approach. This is measuring all of the dollars spent in product markets to purchase all of the goods and services that were produced in our economy. That's method number one. Method number two is the income approach. That's measuring all of the dollars that were spent in resource markets as some form of income for those that took part in producing the GDP that was produced in our economy in a year. That's the income approach. So we're going to focus in this video on method number one, the expenditures approach. The government measures this both ways, and you should get the same answer. So you can see on the left, that's expenditures, and we're going to divide GDP into four categories. We're going to go through each of these four categories. The income approach, you can see GDP is divided into different forms of income. So the expenditures approach, the first category and the largest part of GDP is consumption. Big C, consumption. So this is consumer goods and services. So this is what individuals buy, households buy, not businesses. Individuals and households. This is consumption. So this is a mix of goods and services. And you can see services comprises 60% of consumption. The remaining 40% are goods. And you can see durable goods are 10% of consumption, non-durable goods are 30% of consumption. And the difference here is for a good to be a durable good, it's something that has a useful life of 3 years or more. The second category is investment. So we show that as big I. Sometimes we have a subscript G, meaning gross investment. This is gross investment, and you'll be introduced to other measures of investment later on, but this is gross investment. Try to remember that. This will be explained later. So this is businesses purchasing capital. Remember what capital is in an economics course. Capital is the facilities, which is factories if it's a manufacturer, or even office buildings if it's a services organization like an insurance company or a software developer or a bank. It's the facilities, it's the major equipment that businesses purchase and use to produce their product, including money spent to modernize the facilities and the equipment, to replace older equipment that wore out or became obsolete. All of that is investment expenditure. So this is a certain percentage of GDP because there are companies that produce capital goods and sell them to businesses. Their output is measured as investment, gross investment. Now, a special use of the investment category is to account for the fact that for some industries, and really most industries, if you're producing a good, sometimes the good is produced in one year and consumed in the next year. Think of an automobile, for example. General Motors produces a lot of automobiles in December, let's say, that are not consumed in December because they've got to be shipped. They've got to make it. They've got to go through the supply chain, right? They've got to make it to the dealer. The dealer then resells them, and they might be consumed in March of the following year or even later than that. Well, we would like for the production of those autos to be counted in the year that they were actually produced. And so what we do is, what the federal government does is they use this investment category to measure goods that were produced, it's the end of the year, goods that were produced but are still in inventory and have not been sold or consumed yet by the end users, so that they get measured as being produced in the year they were produced. Then in the following year, they get deducted from GDP and then added to consumption because they get consumed the next year. So there's no net change to GDP the following year is what I mean. And I'll show you an example of this shortly. But that is a special use of the investment category to show changes in inventories to account for products that are produced in one year and consumed in the next. We want for them to be measured as GDP in the year that they were actually produced. Now, Big G, this is the next category. Big G stands for government spending or government expenditures, sometimes it's called. This is everything that the government produces. Think about, what does the government do for you? They collect taxes, right? That's the revenue. Then they spend that on something. Well, what is it that they produce? Well, how about military services? That the military budget is part of G. They produce defense services, right? And included in there would be all the salaries of all of the military personnel and all of the other spending that the military does to purchase weapon systems and communication systems and logistics equipment. Everything they spend their money on is included there. What else does the government do to you? Do for you? That was a Freudian slip. What do they do for you? And don't think of just the federal government. State governments and local governments are included in Big G too. How about public education? That's produced by the government, right? K through 12 education. Now that is produced, the funding comes from a combination usually of state funding and local funding. Not so much of that comes from the federal government, but that's in G too, and that's a big part of G. What else does the government spend money on or produce? Well, how about infrastructure spending? That's included in G. You can almost look through, if you want to think about the federal government, think about who is in the president's cabinet, the major divisions of our federal government. And you can, the Secretary of Defense is one, so the military budget's in there. Secretary of Labor, all of spending in that department. Secretary of Transportation, so all of transportation spending, a lot of the infrastructure spending is in that department. So anyway, you can go through the president's cabinet and think about federal spending that way. Now, how about law enforcement? Law enforcement is produced locally, so local municipalities produce law enforcement. They have police forces. It's produced on the state level. There's state law enforcement, state troopers. And then there's federal law enforcement, the FBI, for example. So all of that's included in there. Other public services that your local municipality offers for you. And so anyway, all of this is in G. What you do not count in the expenditures approach to measuring GDP is government transfer payments. So for example, Social Security payments, when they are made to beneficiaries, think about it, nothing's really produced when that happens, right? The government is just collecting money from the people that are paying into the system and then paying beneficiaries in the year that they're eligible to draw the benefits. But they're not really producing anything. I mean, they're producing some administrative services to administer that program that gets measured as GDP, but not the whole amount of the Social Security payments that are made every year. So in general, we're going to say that using the expenditures approach, we're not going to count public transfer payments. This is whenever the government is paying any kind of benefit to someone via a government program. This also includes unemployment payments and welfare payments, that kind of thing. These are all public transfer payments and will not be counted using the expenditures approach. And then the last category is meant to account for the fact that some of what gets consumed in our economy was not produced here. And so we shouldn't count it as being part of our GDP. When an automobile is imported from Germany, I drive a Mini Cooper and it was produced in the Netherlands. It was imported and it was consumed here, so it gets measured. Let's say it was $20,000. It was more than that. But if it was only $20,000, then consumption went up by $20,000 when I bought the car. However, it was imported, so there's a negative $20,000 counted in the net exports category because you have exports minus imports. So that was an import, so it would have a negative number. So it cancels out the negative $20,000 in the imports net exports category, cancels out the positive $20,000 in consumption in the year that I purchased it. And for exports, we do want to count things that were produced and exported, but they don't get measured when they're consumed because they're not consumed here. So if we export, Ford Motor Company produces an automobile and sells them in Canada, well, we want to measure them as part of our GDP, even though they're not measured as being consumed here. That's normally when they get measured. So we measure them as exports. They're consumed in Canada. So for us, then the value of those automobiles are measured in this category, net exports. So there's our equation. GDP is divided into 4 categories, really 3 plus an adjustment category. The first, again, is consumption. That's all consumer goods and services. The second one is investment, and that is gross investment. Remember, that is businesses purchase capital every year. And there are companies out there that produce that capital and sell it to the businesses. So this is renovations to facilities, building of new facilities, replacing equipment, buying new equipment. All of that is included in I. So there are companies that produce equipment, produce capital goods. That's all what I is. And then G, remember, is government expenditures. This is the government, and everything they produce is included there. And then the adjustment for exports minus imports to make sure that we are measuring everything that was produced in our economy. And there you have it. Let's take a look at 1 year of data. Here it is. This was 2018. So GDP was, now these are in billions, so $20 trillion, $20,864 billion. So how is that divided up? Well, it looks like consumption was $14 trillion of the $20 trillion. That was 68% of GDP. Remember I told you it was about 2/3, a little bit more than that. Investment, $3.7 trillion. That was 18% of GDP. So again, think about what investment is. This is spending money on capital goods. That's how much money was spent collectively by all the businesses in our economy and the governments, because governments purchase capital too. They own purchase capital to produce what they produce. Well, 18% of everything that was purchased in the economy in the year was capital goods. And that when you do that, if you're an individual company, some percentage of your budget is the capital budget. The rest is the operating budget. And when you invest in your capital as a business, you are investing in future production that's going to happen in future years, because these capital goods last for a long time, right? So you should always be setting aside some dollars each year to upgrade your capital or even expand it if the company is growing. In years where you don't do that, then you are using up your capital and not replacing the capital that is getting worn out or is becoming obsolete, right? So the larger that percentage is, the better. 20% would be even better if it was 20% of GDP. In years where we're having a recession, it's closer to 15% of GDP because companies defer or stop spending on capital in bad budget years. All right, and then government spending. How about this? Does this surprise you? $3.569 trillion, and that's 17% of GDP. We consider ourselves to be the preeminent market system economy, don't we? And we are capitalists. It's the philosophy we live by. It's the philosophy our economy is based on anyway. And yet 17% of output is produced by the government or governments in general. That's what that means. If you believe in capitalism, you believe that private industry, private companies should be producing the goods and services. Well, even though we believe that, there are, and we talked about what it is the government is producing, there are some things you don't want to trust in the hands of private companies, like military services, right? So we think the government should produce that. Nobody argues with that. Public education, same thing. You want to guarantee that everybody has access to at least K through 12 education. And so the government's going to provide that. We're going to tax the people and then provide that rather than just rely on private schools. We'll allow private schools to exist also, but we don't want to only have private schools, because if it's not profitable, they might just leave an area and there would be no schools. So the government needs to provide that. Well, there's other things the government needs to do, and infrastructure, and we talked about what they are. So that amounts to, at least in 2018, 17% of output. It's fairly significant. We have a trade deficit, which means we are importing more than we export. And so how big of a problem is it? Well, it's about 3.2% of GDP. So ideally, and you might think, well, is that bad that we're importing more than we export? It makes it seem like we're richer than other countries are, and we are purchasing everything we produce, and we are even purchasing additional produced by other countries. Well, think of the net flow of dollars. There's a net flow of dollars out of our economy. That's the bad part. It would be better if we were producing more and we were producing at least as much as we need to satisfy domestic demand for goods and services. That would be better. If we were producing 3.2% more GDP, maybe we wouldn't need to have this trade deficit. Time for a quiz. Did you just fall off your chair? Didn't mean to do that to you. Okay, so write down your equation. GDP equals C plus I plus G plus, in parentheses, X minus M, net exports. All right, and think about what happens to GDP, what's the adjustment to GDP, what's the effect on GDP when each of these things happens. All right, part A, this is the easiest one. Debbie spends $200 to buy her husband dinner at the finest restaurant in Boston. So which category is affected? That's consumption, right? So under C, you would show plus $200. And then on the other side of the equal sign, if C goes up by $200, that means GDP went up by $200, right? Perfect. All right, let's go on to part B. Sarah spends $1,800 on a new laptop to use in her publishing business. The laptop was built in China. There's actually two pieces of information there, right? Which category or categories are affected? She spends $1,800 on a new laptop. First of all, which category does that affect? Well, remember, this is for use in her publishing business. This is a business asset. This is a capital good. This is an investment good. So I, investment, goes up by $1,800 when she spends that. That is a business spending on equipment. So that's I. That's not consumption. If she was buying it for her personal use to use at home, then it would be consumption. This is to use for her business. So I goes up by $1,800. But wait a minute, it was built in China. So we need to, under net exports, show a negative $1,800. It was not produced in our economy, so we don't want our GDP to go up by $1,800, do we? So it's $1,800 under I, negative $1,800 under net exports. What's the net effect on GDP? No change. Now, actually, import services were produced in our economy, but so some portion of that $1,800 does actually get counted towards GDP, but we're not going to split hairs here. Now, part C. Jane spends $1,200 on a computer to use in her editing business. Okay, now we know that's I, right, when she spends that money. She got last year's model on sale for a great price from a local manufacturer. Wait a minute now. There's actually 2 years involved here. We need to have a year 1 and a year 2, don't we? Last year is year 1. This year's year 2. Let's think about what happened to GDP each of those 2 years. All right, so we have our equation. GDP equals C plus I plus G plus the quantity X minus M. And we have underneath that year 1 and year 2. Year 1 was last year. Well, let's see. It was produced, but it was not consumed last year, right? It was not sold. So this is year 1. we want it to be counted in GDP of year one, don't we? The year that it was actually produced in our economy. It was sold in year two, but it was actually produced in year one. That's the year we want it to count towards GDP. The way we do this is we use the investment category. This is that special use of investment to account for inventories that have goods that were produced that year when the year changes over. And then the second year they get drawn out of inventory and get sold or consumed. All right, so year one, this computer, this $1,200 computer, was placed in inventory. So under investment, we're going to show plus $1,200 in year one. All right? And that's all in year one. Well, if you have a plus $1,200 under I on the other side of your equal sign, that means GDP went up by $1,200 in year one. That was last year. All right, now it's year two, this year. She purchases it for use in her editing business. That means that's a positive $1,200 under investment because she's purchasing capital goods. But then we need to deduct under investment because it's coming out of inventories. So in year two, under the investment category, we have a plus $1,200, that's when she makes the purchase, minus $1,200 because it came out of inventory, it did not get produced. So they cancel each other out, and then on the other side of the equal sign, we have a zero, no net change to GDP in year two. And then finally, part D. Again, we're spanning 2 years here, aren't we? General Motors builds 500 million worth of cars, but consumers only buy 470 million worth of them. So that's this year. Next year, they would purchase the remainder of them, right? So if this is year one, this current year, General Motors built 500 million worth of cars. Well, just saying that tells you that we want to count in GDP $500 million worth of cars, right? They were really produced this year, even though they were not all consumed this year. How are we going to account for that? Here's how we do it. Where's our equation? There it is. I just wrote it down. GDP equals C plus I plus G plus the quantity X minus M. Well, under consumption, we have 470 million, right? That's the cars that were consumed this year. There's 30 million remaining that were not consumed this year. They were in inventory at the end of the year. So under I, we have 30 million. Okay? So we have 470 plus 30 on the right side of the equal sign. What's on the left side? 500 million, just like we wanted. Then in year two, we're not asked this question, but in year two, which is next year, we have $30 million of consumption because the remaining 30 million of cars are sold, but they come out of inventory. So in year two, we have plus 30 million under C and minus 30 million under I. So what's the net change to GDP? Zero. And you can see I have the answers here for you in red. And you can take a look at that and sort of absorb it. And here is C and D. And I think we're all ready now for the income approach to GDP. We will take a look at that in Chapter 5, Part D. See you there.